This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. Asian stocks have suffered losses after Nvidia's results failed to revive the AI rally, sending the Nasdaq 100 to November lows. We hear this hour from the Amazon CEO Andy Jassy on their AI outlook. The dollar higher as President Trump says 25% tariffs on Mexico and Canada will hit next week, with an extra 10% tax on Chinese imports. Plus, we hear exclusively from Taiwan's Vice Premier about relations with the US under Trump, the island taking centre stage in critical tech supply chains.
We could see some downside pressure across currencies in Asia, especially since we saw the dollar seeing its best day in about 3 weeks. We had the Japanese yen falling overnight, right now holding at that 149 level against the greenback. And still, Bloomberg Intelligence thinking that perhaps investors are underpricing the risk of BOJ tightening. They see those hikes coming in the spring, not the summer. So if we see an early move from Japan, could we see those gains for the Japanese yen? Right now, Nikkei futures pointing to the upside of 0.5%. We will be seeing those inflationary pressures here in Japan. Tokyo CPI numbers coming out in about half an hour. But of course, what we're following right now is also the reaction to those tariff threats, especially the additional 10% that could be imposed on China. The offshore yuan right now holding at that 729 level. We already saw the reaction on the Aussie Kiwi dollars falling more than 1% overnight, and Aussie yields also under pressure. Take a look at the setup across the U.S. because we saw a mixed finish for Treasury markets. We still are seeing yields at 2025 lows given those economic concerns. Of course, 25% tariffs on Canada and Mexico also to be imposed next week. We're seeing U.S. futures pointing slightly to the upside, but as we mentioned earlier, Nvidia sinking after results. It's now at the lowest level in 5 months, Heidi.
Well, Shery, we're also watching the geopolitical developments, right, particularly when it comes to global trade, with President Trump saying 25% tariffs on Canada and Mexico are on track to take effect on March 4. He also says that he'll impose an additional 10% tax on Chinese imports on the same day. Our Balance of Power co-anchor Kelly Lyons joins us now from Washington. So, Kelly, does this give us some clarification, given yesterday was a really confusing day in terms of the mixed messaging around these dates?
Yeah, Heidi, it does give clarification on at least the day in which he's thinking about imposing these tariffs. As yesterday he suggested it could be April 2nd, but today confirmed it would be Tuesday, March 4th. But it doesn't necessarily give us clarity as to whether or not this is actually going to happen, as we have seen him pull back these tariff threats before. He says what he needs to see is changes in the flow of fentanyl into the U.S. from countries like Canada and Mexico over their borders, and of course suggests that it originates in China, which is why China would also face an additional 10% levy on top of what already has been imposed. So there is obviously still room for conversations to happen between all of these countries. We actually just got some headlines out of a meeting that took place with the Secretary of State, Marco Rubio, and Mexican officials about creating a group to look at arms trafficking and illegal fentanyl specifically. Unclear if that will be enough. But if this does indeed go into effect on Tuesday, it could be just the start of what could be weeks from now, additional tariffs that could impact these countries, as the president maintains. On April 2nd, reciprocal tariffs will go into effect. He's looking at auto tariffs, was talking about tariffs against those European countries that add a value-added tax today when he was meeting with the UK Prime Minister Keir Starmer in the Oval Office. Although I guess if we're looking for one area of trade optimism, the president did suggest today he does think a trade deal with the UK specifically could be in the near future, and that could mean the UK avoids tariffs, even if some of these other countries cannot.
Yeah, lots to discuss with the UK Prime Minister, especially when it comes to Ukraine as well. What did we hear?
Well, we heard from both of these leaders that they are supportive of the negotiations the U.S. has begun with Russia toward ending the war. The UK Prime Minister Keir Starmer did commend the president for his efforts on that, but he made it very clear that he wants to make sure any kind of peace deal is one that can last. And in the UK's mind, as well as in the mind of France, as we heard from the French President Emmanuel Macron, who visited the White House earlier this week, is that they need U.S. backing for peacekeeping forces that they are willing to provide in order to maintain things steady in Ukraine once a deal is reached. We didn't necessarily get a commitment from President Trump today, however, that he's willing to provide that. He suggested that the UK is strong enough to stand alone, also noting that an agreement that he expects to sign tomorrow when the Ukrainian President Vladimir Zelenskiy visits the White House on minerals, and the U.S. having essentially a share of the revenues from things like oil and gas, as well as minerals that are derived from Ukraine will create an economic guarantee that makes additional security guarantees unnecessary, that will be enough of a deterrent factor to make sure that Russia does not invade Ukraine again. And we did hear President Trump say today that he takes Vladimir Putin at his word. He does not think he will go back on it, even if that isn't necessarily what we heard from the Prime Minister.
All right, Caitlin Lyons there, anchor of Bloomberg's Balance of Power with the latest from Washington. And markets, of course, continuing to weigh in on President Trump's decision to enact tariffs, as well as looking ahead to U.S. core PCE inflation data due Friday. For more, let's bring in Bloomberg opinion columnist John Authers. John, good to have you with us. So what are the key drivers right now for the markets? We have for the longest time trying to understand what these tariffs mean in terms of market investments, but at the same time now, U.S. core PCE coming to the forefront and what the Fed might do.
Yeah, I think in the case of the Fed, barring something very, very surprising in either direction on inflation, that still doesn't really matter. The Fed can't do very much until it has greater clarity about what is happening with tariffs. In the short term, tariffs create more inflation, period. No question about that. That's certainly what everybody in the market assumes. And so if they have to deal with a situation where tariffs are going up, still unclear, then the Fed is going to have to react differently. I think the PCE numbers that we get tomorrow, they're reasonably clear because we get so many of the components in advance. So they're very lagged numbers, even though they're very important. I think they're basically consistent with where we are at the moment, or where we've been for some months, which is that disinflation has stopped. But it's not like inflation is taking off again yet, and a lot depends on what effects, what policies come out of this administration.
John, when you take a look across asset classes, it's interesting to sort of make comparisons with how we saw the last Trump administration and how markets, the psychology worked then, right? Are we seeing a repeat, particularly when it comes to assets like the US dollar? Because certainly when it comes to, equities, US equities are going through a tough patch at the moment, and you're seeing, big moves, everything from Bitcoin to gold as well.
Yeah, well, I can give you one factoid I'm very proud to have just calculated, was the bad day for NVIDIA. Means that as of today, the S&P 500 has actually performed worse since election day than the FTSE All-World index, excluding the US. That is, the American first trade meant that America far outperformed the rest of the world for about 6-7 weeks after the election, and it's now given up all of those gains. You would have been better off investing in the rest of the world than in the States on election day. So, certainly that is not something I or many other people saw coming, but that's the way the market is reacting. Certainly, and that's different from Trump 2.0, which was where you had, from Trump 1.0, which, although we tend to forget about it now, was a period of what was referred to as coordinated global economic recovery. A lot of other countries were doing very well as well at that point, whereas now people are perceiving this as more of a zero-sum game. In terms of the dollar, it's had a bad run. The big line in favor of a stronger dollar is that tariffs will come in. Tariffs, more or less, again, directly lead to a strengthening of the currency of the country that imposes them. The reason the dollar has been on such a weak run is that, among all the other things that Donald Trump has done to date, when it comes to tariffs, he said a lot but hasn't actually done anything apart from the extra 10% tariff on China, when he had been talking about 60% during the campaign. The market has interpreted that so far as actually we're not going to get huge amounts of tariffs extra, therefore we can sell the dollar. And you saw a response today, or an anxious response to the suggestion today that he's going to be moving ahead with tariffs on Canada and Mexico next week. Still something I think people will need to see to believe. I don't think those tariffs are anything like in the price so far.
A Bloomberg opinion columnist, John Authers there. Coming up on the Asia trade, while the Meltzer Centre for Diversity, Inclusion and Belonging thinks corporate America is not abandoning, but rebranding its DEI strategy. And later on, Julius Baer will be giving us their China market outlook, plus University of Melbourne joining us to talk through Vladimir Zelenskiy's upcoming visit to the White House. This is Bloomberg. This is the Asia Trade. Some of the other stories we're following this hour. EU leaders will call for increased flexibility in their funding rules to boost defence spending, responding to growing challenges posed by Russia and President Trump. Draft conclusions for a March 6 summit seen by Bloomberg show European Commission President Ursula von der Leyen is expected to present a letter with funding options. Earlier this week, she called the situation a once-in-a-generation moment. China says efforts to facilitate talks with the US military are in their early stages. The development could ease friction between the two nations at odds over issues including semiconductor access, investment and tariffs. The last publicly known contact between senior Chinese and American military officials was in September during the Biden administration.
President Trump's weakening support to Ukraine is also casting doubt on a long-held policy of strategic ambiguity toward Taiwan. Our tech reporter Annabelle Julius joins us from Taipei. And Belle, I remember when first Russia invaded Ukraine, there was a lot of speculation that perhaps this could lead to China doing the same for Taiwan. What are we hearing right now on the ground, and what are the concerns?
Yeah, well, that's exactly it, Shery. It's safe to say that the events in Ukraine and this real about turn from the US toward Kyiv is being watched very closely here. The purpose of our trip, as you know, this week has been to focus on the drone industry and the build out of that industry and that technology. But it's that real question of exactly what are they building drones for? Because there's that overall goal to be able to defend itself from any sort of military blockade or invasion from China were it ever to eventuate. But the question as well is whether Taipei is still counting on the US to come to its defenses. Of course, as you said, the US has for decades now maintained this policy of strategic ambiguity toward Taiwan, so not making it clear either to China or to Taiwan whether it would actually come in and step in the event of any sort of incursion from China. President Biden, in his term in office, appeared to counter that several times, saying that they would protect Taiwan. But President Trump this week just has said that he wouldn't provide any sort of assurance at any point in time. And so that has been really very closely watched by Taipei, of course. And yesterday we actually had the chance to sit down with the Vice Premier Cheng Li-chun exclusively for an interview. And we began by asking where the US-Taiwan relationship is likely to head over the next 4 years.
美国一直是台湾重要的伙伴国家，不论是在区域安全或经贸合作上那所以我们也
The US has always been Taiwan's most important partner in terms of regional security and in trade. We are attentive to the policies of the new US administration, and different local agencies have been studying new areas for cooperation between us. The more important thing is identifying a strategic direction for the US and Taiwan and maintaining a mutually beneficial working relationship, so we can build a democratic supply chain that strengthens the US's leadership in the global high-tech industry, while also helping Taiwan maintain its competitiveness in making contributions to high-tech development.
我们也看到川普政府上任以来
And what is your assessment of the way that President Trump has changed his position very radically from the Biden administration on Ukraine?
我想我国一直都持续的在关注
Taiwan has been monitoring the development of the war in Ukraine and related updates from Europe. We want to do our part for the Indo-Pacific region. Enhancing military capabilities is the basis for peace. We want the Taiwanese people to recognize this. Therefore, we are not only committed to building up our defence capabilities, we are also strengthening our economic resilience. This way, we can continue to take on important roles and increase our contributions to the world. President Lei had set the 4 pillars for peace. They represent objectives like enhancing Taiwan's defence capability, enhancing economic safety and resilience, continuing cooperation with like-minded countries, and lastly, supporting orderly exchanges between Taiwan and China.
How does Taiwan prepare, though, for other eventualities? Because there's the tariff risk that is still very present, not yet fully clarified, but there's the chance that we see 25% tariffs on Taiwan semiconductors. How is the island preparing for that?
我们都密切的在关注美国新政府相关的。
We are tracking new policies from the Trump administration closely. We want to show that the future of the Taiwan-US cooperation is focused on cutting-edge technology. This is mutually beneficial and it should be a shared goal. And we're willing to expand our investments in the US with the aim to amplify our innovations in technology, including AI, chips and drones, and even R&D in future technologies. We want to stay leaders in the high-tech industry amongst democratic countries. This strategy is critical for both of us. We will also make efforts to balance trade in our increased investments in the US.
Do you think that the US is still a reliable security partner to Taiwan?
我们认为台美是区域安全跟经贸和。
We are important partners on regional security, trade and economic collaboration. We hope to deepen ties with the US, and we believe it will be done on the basis of the Taiwan Relations Act and 6 assurances. Since Trump became president, he's emphasized the importance of keeping the cross-strait peaceful and doesn't want to see a unilateral change of status quo by force, and most democratic countries share this same view.
So throughout that conversation with Taiwan's Vice Premier, it was really an effort to emphasize the deep relationship that the US and Taiwan have had for a long time now, an effort as well to emphasize the value that Taiwan gives to the US in helping it or allowing it to maintain any sort of technological edge over China, and the need for that as well. But at the same time, the Vice Premier, who also oversees the drone efforts for the island, vowing to continue to boost its own self-defense capabilities.
Our Bloomberg tech reporter Annabelle Julius there. More ahead on the Asia trade. This is Bloomberg. Amazon CEO Andy Jassy says chip shortages and power constraints are still restricting growth in the company's cloud computing division, AWS. He told us that most of the planned $100 billion capex spend will go towards generative AI.
We're spending a pretty significant amount of capex, and the lion's share of it is on generative AI. We've said in our AWS business, even though generative AI for us is a many billion-dollar a year business and growing triple-digit percentages year over year, that if we had even more capacity, we could use it and monetize it. And we have this really interesting and very fortunate flywheel in AI inside of Amazon, which is if your mission is to make customers' lives easier and better every day, which it is for us, and if you believe that all the customer experiences we know of today are going to be reinvented through generative AI, which we also believe. If you believe those two things, you're going to be building a lot of generative AI apps. If you build a lot of generative AI apps, by the way, other companies are too, on top of AWS, which is the leading technology infrastructure platform. So if there are a lot of generative AI apps being built on top of you, you can't help but get a lot of feedback from people on how they want those building blocks that create generative AI to be better. And if you're willing to invest in those building blocks, which we are, as you know, with our own chips, with Trainium, and with our own frontier model, with Amazon Nova, and model building services, and SageMaker AI, and Bedrock, if you're willing to invest in those building blocks, and you're getting a lot of feedback, they get better much more quickly, which can't help but make it easier and quicker for people to build generative AI applications, which means you get more running on the platform. So that flywheel is very unique for Amazon.
The lion's share, though, you did say basically a $100 billion run rate for capex expenditure. Can you give us even like a percentage breakdown of how much that goes to distribution, logistics, and how much goes to AI?
Well, lion's share is, tells you most of it. Most of it. The lion's share is more than 50%. Yes.
Is it more than 80%?
We're playing the warmer and colder game.
Yes, exactly. I love a game. But talk to us about that capacity that you talked about.
Yeah.
AWS could grow even faster if you had all the chips that you needed, all the power you needed, the motherboards you needed. How much faster could AWS grow?
It's hard to put an exact percentage, but I do think it could be growing faster. I mean, I'm confident it could be growing faster. And you know, there is, you know, for a long time, there still aren't as many chips as we all want. We have, we're fortunate in that we're very big partners with NVIDIA, but then we also have our own custom AI silicon in Trainium 2, which we just released at reInvent, which is 30 to 40% more price performant than the GPU-powered instances, which is a big deal at scale if you're doing generative AI on the inference side. So we have maybe more chips than some others might have access to, but we still don't have enough. And then there just is not enough power in the world right now. And we're all working really hard on that. I expect that to relieve some the second half of this year. But right now, and you know, the world can change, but right now we have just insatiable demand.
We heard amazing demand coming from Jensen Huang, who had his numbers out yesterday in NVIDIA. Was there a limitation on the NVIDIA chips in particular that pulled back capacity? And at what point do you think you can depend even more on your own in-house built chips to offset any of that?
Well, you know, I would say, I mean, there's a lot of demand for generative AI right now. People are very excited about it. I think that all the different providers of chips have been constrained to some extent. I think some of the new generations maybe have gone through different evolutions and when they're going to be released, maybe a little later than people thought. There are some components like motherboards and things like that we all use that particular ones are in shorter supply than others. So, you know, I do think there are some supply chain issues which I expect to get better. You know, people are very excited about Trainium 2, to your question on whether we could see more demand there. And we have gone back at least a couple occasions to make more Trainium 2 than we'd intended because we have so much demand. So I expect that we'll have customers for as long as I can foresee wanting to run compute on instances that have NVIDIA chips, but I think a lot of the demand will also be served by Trainium.
The customers that you couldn't serve because of the limited capacity, is it that you just had to pull it back from everyone a little bit more generally, or who lost out here, do you think?
It's always a combination. I mean, there's, for people that just have a very small amount of accelerators that they need, they don't usually have a problem. We have something called capacity blocks, which it's kind of like an on-demand way to use accelerators and generative AI chips, and that continues to grow. It's really the folks who have built, you know, have an idea for a new application, but they need a lot of chips where if we don't have the capacity, we have to give them what we can give them and give it to them as fast as we can and push our partners to get it in sooner. And they can't get their initiatives done as quickly as they want to if the capacity isn't there.
Anthropic's had all the capacity it needs? You've got a close relationship?
Yeah, we have a very close partnership with Anthropic. We have this project called Project Rainier with them. They're building their next model, their next version of their frontier model on top of Trainium 2 and our custom AI silicon. They're going to use over 400,000 Trainium 2 chips. And so, yes, they have capacity.
Amazon CEO Andy Jassy with Bloomberg Technology co-anchor Caroline Hyde. We have more ahead on the Asia trade. This is Bloomberg. Take a look at how we're setting up for the Japanese market opens after stocks gained ground in the previous session. We're watching the Japanese yen falling from that 4-month high against the U.S. dollar. We are now looking at Tokyo CPI numbers, excluding fresh food, coming in at 2.2% growth year on year, and really coming in slightly below expectations. When it comes to fresh food exclusion plus energy exclusion, we're talking about core CPI, also a slight miss and below economists' expectations of 1.9% year-on-year growth. The headline number is a gain of 2.9% year-on-year, also slightly below what economists had expected. But of course, we have to factor in the fact that we got a resumption of energy subsidies across the country, and still the Tokyo CPI numbers giving you an indication of what national numbers could look like in the future. We're still seeing that nationwide reading accelerating and being above the BOJ's price target. Core CPI rising 2.2% year-on-year for the month of February, as we're seeing the Japanese yen now pare back some of those earlier losses and trading close to that 150 level against the U.S. dollar. Of course, we have seen it at around that 4-month high against the greenback. We'll be seeing how the markets trade around, of course, the stronger Japanese yen, but also the CPI numbers when markets and equity markets open in Japan. A couple of stocks that we'll be watching very closely, Nissan, 7 and I. We recently saw the collapse of those ambitious rescue plans for those companies. The firms were vulnerable to foreign takeovers now. Investors are now targeting other struggling Japanese companies, betting that the country's corporate landscape is open to change. Bloomberg Intelligence senior industrials analyst Takeshi Kitaura joins us now with the latest. Takeshi, so how does this really change the risk for Japanese companies? Because when we first saw these efforts to rescue these companies from foreign takeovers, we thought perhaps domestic firms were coming together in order to avoid being really bought out by these international investors. But what could the failure of this to happen mean for the broader deal-making environment here?
Right. So I think, first of all, whether it's a failure or not, it's yet to be seen. There are further discussions on each of the deals, I would think. But I think overall it is a wake-up call for Japan to actually drive change, whether it's by the company itself or not. And it's not just for foreign companies trying to take over Japanese companies. We are seeing cases like Nidec trying to take over Makino Milling, which is a small machine tools company. And actually, Makino Milling has put out a new sort of midterm plan to raise payout ratio and try to target a higher ROE as well. So overall, it is driving change in Japan. And I generally think it's a good thing to have these discussions and for Japanese companies to further improve their financials ahead in eye of investors' sort of focus.
Because what happens in Japan is that we have a lot of these cash-rich companies, right? So what does this mean for the future of deal-making in the country? Will we see more of it or less?
I would think there's more, and there's also a lot of divesting opportunities as well. Some of the companies that I follow trade below book at times. So they need to change and raise their ROE. One company like THK, they've announced to lower their equity base to reach ROE of above 10% and continue to pay out their cash to get there. So overall, I think the change is coming and it's already there, even if there's no takeover. If you do have extra cash, there will be an opportunity to pay back to investors, but also do M&A to strengthen some of their core business segments as well.
So who are the players that we're talking about right now? Because we have even heard about private equity firms being interested as well.
So I think it'll be all around. All the businesses, they want to strengthen the core business while divesting some of the non-core assets. Mitsubishi Electric, for example, wants to follow some of the footsteps of similar to Hitachi to go more digital and raise their profit margins. And some of their core assets might be out for divestment in the future. Hitachi has done a lot of that, but they also need to target further expansion of their ROE and margins as well. So I think within that scope, companies will be more eager to do M&A by themselves, private equity also, and there will be also overseas interest in Japan as well, considering that the overall valuation of Japanese companies compared to the US would be much lower.
Industrials analyst Takeshi Kitaura there. We do have some breaking news when it comes to Star Entertainment just crossing the Bloomberg. An update when it comes to the financial situation, of course, which remains tenuous for the casino operator here in Australia. Star saying that they continue to explore possibility of liquidity solutions. They expect to get liquidity proposals today. Star shares will remain suspended from March 3rd if the results are not filed, and saying that there remains material uncertainty to continue continue as a going concern. We're seeing that trading pause this morning amid speculation really about the viability now of its very business. They're scheduled to release first half earnings later on Friday. And we just don't really know what's going to happen from here, but that suspension will take place from March 3rd if the results are not filed. The directors have been unable to sign off on the accounts, declaring the company was a going concern as of Thursday evening, according to the latest local reporting. They've been unable also to raise short-term funding to meet near-term payments, including the likes of payroll, according to that same reporting as well. This has been a crisis ongoing for Star Entertainment since a regulatory investigation into its Sydney casino back in 2022. That found that it had lax anti-money laundering controls, allowing patrons to flout China's capital rules, encouraging problem gamblers, and other findings as well. We also had a second inquiry that uncovered other additional licence breaches, including the falsification of records. So we continue to see really these mounting difficulties for Star Entertainment, really material uncertainty to continue as an ongoing concern in that trading update today. Let's take a look at what we're watching when it comes to the rest of these markets as we end out what has been really a turbulent week and a turbulent February, right? This is a picture as we expect to see Asian shares broadly to continue falling. The Nvidia effect really wasn't enough to boost any sort of buying significantly on Wall Street. In fact, we saw heavy selling in the overnight session driven by these, what was perceived to be underwhelming Nvidia results, even though they were quite solid, but also, of course, the impact of the US tariff uncertainties and mixed economic data there as well. Here in Australia, where trading is underway for just about 40 minutes in the cash session, we are seeing every sector pretty much trading in the red at the moment, with the steepest declines coming from these growth-sensitive sectors. Materials off by 1.8%. Some of those consumer and tech names well over 1% lower there as well. Well, Hong Kong's sole delegates to China's National People's Congress Standing Committee says she's readying proposals to be presented next week to the key political gathering. Starry Lee also told us how the city government is navigating the increasing tensions between Beijing and Washington.
Government do respond separately for each of the important act by different government and organization. I would say that we have to maintain Hong Kong as an important, gateway to different cities in the world, and we have to maintain our international contact to different parts of the world in order to, attract more talent, enterprises, and technology to come.
Given the fact that there are these external shocks potentially from a protracted trade war, and that the slowing Chinese economy is going to be a priority in Beijing next week, when you're there, what do you think is a reasonable deliverable for you as a representative of Hong Kong to get from the two meetings next week?
I think we have the duty to raise different suggestions to the central government.
Expanding the multiple entry visas beyond Shenzhen?
Yeah, this is one of the suggestions that we will make, because this policy will help to, further facilitate the movement of people and talent. And if you compare, there are a lot of visa-free arrangement for foreign people to come to our country. But, as when you compare to Hong Kong's situation, they even need to apply. Therefore, there are room for that visa arrangement to extend to different cities in Greater Bay Area and also to Shanghai and Beijing. Of course, it can also help to benefit our travel sectors and also the retail sector as well.
Do you feel that Beijing is getting a little bit impatient, though, with the pace of integration? You mentioned the Greater Bay, the greater integration between China and the Greater Bay and the greater mainland economy as well. Xiao Baolong was here recently. He talked about how he was very concerned about the pace of integration on the grand scheme of things. What's your response to that?
I think nowadays, things are changing. We are all facing different challenges. We need a quickened procedures, and we need some, mechanism breakthrough in order to further quicken the development of infrastructure, etc., especially in hotel area, I think. Greater Bay Area, of course, is one big area, but I think hotel is another important concern raised by Sara, right? Because we are, the modernization of our country need to have high technology development, and hotel are being positioned as one of them. And now, up to now, still they are lacking infrastructure, lacking the world rate. I think this is something that we need to pay more and more attention.
Hong Kong Legislative Council member Shery Lee speaking with Bloomberg's chief North Asia correspondent Stephen Engel. We have more ahead on the Asia trade. This is Bloomberg. Goldman Sachs has erased diversity targets from a key regulatory filing, becoming the latest Wall Street firm to turn away from specific goals for a more representative workforce after an executive order from President Trump. Goldman's DEI retreat comes after it canceled a mandate for diversity at firms seeking its services on IPOs and follows a wave of about-faces on the issue by rivals in the industry. Let's bring in our next guest, who says corporate America isn't abandoning DEI, it's just rebranding it. With us now is David Glasgow, Executive Director at the Meltzer Center for Diversity, Inclusion and Belonging. David, great to have you with us. Of course, I mentioned Goldman Sachs, but of course we had Citigroup as well in the finance sector, not to mention the likes of Meta, Pepsi as well. I do wonder, are these real retreats or, as you say, just rebranding? And will it make a difference when it comes to results in the diversity of the workforce?
Yeah, I think it's a combination of the two. So there are certainly genuine retreats from certain forms of DEI that organizations consider to be either legally or socially risky. So we see, for example, a move away from targeted programs that were exclusively reserved for members of particular demographic groups, a move away from quotas, certain hard representation goals in the workplace. But there is plenty of other forms of DEI that organizations remain firmly committed to, like trying to recruit talent from a diverse range of backgrounds, for example, or ensure that they have a welcoming and inclusive culture. And so some of it really is a rebranding exercise. And many of the announcements that you see retreating from DEI actually also still say that they believe in creating a fair culture, sourcing talent from a wide range of pools, and creating a welcoming workplace. And then to answer the second part of your question, I do anticipate that some of these retreats will have an effect on the workforce, particularly for those who belong to more marginalized groups, people of color and women and LGBTQ individuals and the like, who may have been counting on their workplace to continue DEI programs in order to create the kind of welcoming environment that they were seeking, and may now see that environment become less welcoming.
How does it compare to past efforts from the government in the United States to have a say when it comes to DEI initiatives? Because now the executive order really labeling this as illegal DEI activities. I do wonder if we have seen such an effort before to push back coming from an administration.
Nothing like we're seeing now. So toward the end of the first Trump administration, the president issued an executive order in September of 2020 that purported to ban federal contractors from engaging in certain forms of DEI training. However, the new set of executive orders coming out of this administration are much more aggressive in targeting DEI programs, of requiring federal contractors to certify that they're not engaging in any unlawful forms of DEI, and threatening civil compliance investigations and lawsuits to target companies that are engaged in forms of DEI that are disfavored by this administration. So we're certainly likely to see plenty more activity in this area as the administration uses its federal agencies to conduct those investigations.
David, you've written about how there's a deep conservatism in parts of America, and there are simply just parts of the population that are opposed to racial, to social equality in that sense for certain groups of society. How impactful in a long way for policy and for society more broadly is it that you now have a government that's sort of giving legitimacy to these views?
Yeah, I think it is significant because the previous administration was firmly in favor of DEI programs, but now we've seen a substantial reversal where it makes a big difference when the president himself and where heads of agencies like the Equal Employment Opportunity Commission in the United States, that's the federal agency that enforces federal anti-discrimination law, it makes a real difference when individuals like that are now saying we're not going to prioritize enforcing discrimination claims to protect marginalized workers in the workplace. We're going to use those discrimination laws to actually go after DEI programs. I think what we're likely to see is a kind of backtracking in the progress that corporate America saw after the murder of George Floyd in 2020, when we did see a small but significant increase in representation, say, of black executives or of women in the workplace. And I think it's likely to engage in some backsliding now.
Everyone watches the US, and we have seen sort of similar swings in terms of political swings in other elections over the past year. When it comes to somewhere like Australia, do you see this sort of anti-DEI backlash sort of seeping into some of these other countries, particularly as here we've had, you know, an unsuccessful referendum on The Voice and now a lot of debate over, you know, other issues like welcome to country and money being spent on that sort of thing?
To some extent. So I am from Australia originally, and I do think that there is a strain of conservatism in Australia that could be imported from the United States on some of these issues. I noticed, for example, that Peter Dutton made a statement against diversity and inclusion efforts within the government recently. So if he is elected in the upcoming federal election, then certainly that could pour fuel on the fire there. However, there are certain legal frameworks in Australia that protect a lot of diversity and inclusion related programs. So for instance, many discrimination laws in Australia explicitly protect organisations who wish to engage in special measures, which means positive action that they wish to take to protect marginalised groups within the workplace. Whereas the United States does not contain that kind of legislative protection for DEI, and that's what's really opened the door for a lot of the anti-DEI lawsuits that we're seeing over in the United States.
David, really great to have you with us. David Glasgow, who's Executive Director at the Meltzer Centre. Let's get back to one of the movers that we're seeing when it comes to Star Entertainment, just the amount of challenges, financial and otherwise, continuing to pile onto this company as we had that announcement a bit earlier in terms of the material uncertainty that continues to plague as an ongoing concern. So the shares will be suspended from March 3rd if the results that are due later on today, on Friday, it is here in Sydney, are not filed. We are seeing that move when it comes to Star Entertainment, off by just shy of about 8%, falling at the moment as the company says it continues to explore liquidity solutions. Shery.
Heidi, we're getting breaking news out of Japan. We're getting the industrial output numbers for the month of January, a contraction as expected of 1.1% month on month. We continue to see a deepening contraction in factory output in Japan. We have seen exports of factory equipment, electronic parts all weakening. We have seen a pullback in demand for smartphones as well. So the year-on-year number is also growth of only 2.6%, missing to the downside on expectations of 2.8% growth. When it comes to retail sales numbers, year-on-year in line with expectations, acceleration of 3.9%, also acceleration from the previous month. We're also seeing it going into expansion territory on a monthly basis, growing 0.5% instead of a contraction like we saw in the month of December. So despite the fact that we continue to see accelerating inflation, also higher prices for consumers, retail sales and consumers seem to continue to be spending. Year-on-year growth, 3.9%. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at what the yen is doing at the moment, as we just had the really tranche of data when it comes to industrial output declining by 1.1% for the month of January month on month. We saw a rise in retail sales year on year that met expectations more or less, and we also saw on a year-on-year basis industrial output also missing expectations a bit. We did see the dollar kind of seeing a resurgence there as the latest US tariff talk hitting some of those relevant currencies like the Canadian loonie and the Mexican peso. Let's bring Garfield Reynolds, who leads our Markets Live Asia coverage. And it's quite interesting, the moves that we're continuing to see in the US dollar, right? We were talking to John Authors earlier and say so far we're seeing kind of almost an expectation that this is a repeat of Trump 1.0 when things have been quite different this time around.
Well, this time around is like Trump 1.0 turbocharged, as it were, or exponentially increased in terms of volatility and also the pace. First time round, Trump talked a lot about tariffs and about trade imbalances, was much more focused on China than on other areas, but there was focus on things like steel and aluminum. But it wasn't until 2018, more than a year into his presidency, that you actually had serious moves to impose tariffs. There were a lot of other things that he moved to do first. So this time round, tariffs are at the center of policy for an administration that is also moving much more rapidly to carry out more radical changes to the global and US economies.
On the other side of that dollar trade, of course, the Japanese yen seeing a little bit of strength as well. How much are investors really factoring in the new economic data that we're getting here for what the BOJ might do?
Well, it looks to be having a small impact. The yen ticked lower. The dollar-yen rate ticked a little bit higher after that softer than expected Tokyo inflation data that came out just now. That's not really likely to have too much of a long-term impact on the Japanese feed into the yen trade, which is that the BOJ is being forced towards fresh rate hikes. So that's yen positive.
Garfield Reynolds there. Well, the market opens in Seoul and Tokyo. And next, this is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens after another sell-off on Wall Street. Of course, Haidi, we're still trying to digest those tariffs that are coming up next week against Canada, against Mexico as well. And President Trump even threatening another 10% on China.
And we saw the Nvidia numbers, kind of robust as they were, still disappointing and failing to revive the exuberance of the AI and tech trade. And we're seeing that malaise sort of spread to sentiment in this Friday session here in Asia.
Yeah, the Nasdaq 100 really falling to the lows that we haven't seen since November. So we'll be watching those tech stocks, those semiconductor names at the open here in Japan, as we have the Japanese yen trading slightly weaker against the US dollar overnight. But remember, we have seen significant strength so far, 4-month highs against the greenback. And Bloomberg Intelligence saying that perhaps investors are underpricing the risk of BOJ tightening to come even faster than economists are expecting, perhaps in the spring instead of the summer. The yen holding at that 150 level against the US dollar, weakening slightly. We had Tokyo CPI numbers, inflation momentum still there, but surprising to the downside a little bit against economists' expectations, given that we had some more energy subsidies coming from the government. Interesting dynamic that we're seeing in eco data right now, because the yen has been very vulnerable to eco data because people are thinking what will happen to the BOJ tightening. But we saw retail sales coming in line with expectations, pretty strong despite the fact that we're seeing prices rising, but factory output actually surprising to the downside. So perhaps seeing more external demand weakening with exports weakening. The Nikkei right now down about 1%. Take a look at how the Kospi is opening right now, because as I said, tariffs threatened by President Trump could be additional 10% on China. All of that having implications, of course, on the semiconductor side of things, on automakers, and that's such an important part of South Korea's market. So we're seeing the Kosdaq also falling about 1.5%, Heidi.
Shery, not a great deal of enthusiasm when it comes to trading here in Australia. We're just an hour underway. We're seeing pretty much every sector they're trading in the red. And not only these growth, trade, global growth-sensitive sectors like mining, for example, as well as some of those consumer names and tech also being led lower by over 1%. The S&P ASX 200, they're off by about 0.8% at this point. The Aussie dollar sitting at 62.33. We did have that sort of bounce back when it comes to the US dollar, which had the biggest intraday move in 3 weeks on account of those tariff kind of details that we heard, right? Reiterating that the 25% tariffs in Canada and Mexico are on track for March 4th. Conversely, we did see the move when it comes to the Canadian and Mexican currencies as well. The Aussie, as well as the Kiwi, as well as the Swedish krona, all lost more than 1% against the greenback in terms of those biggest laggards there. And this, as we continue to also watch really the broader implications when it comes to the latest US data, implications for the Fed. We're seeing Treasury yields hovering pretty close to those 2025 lows on really kind of the broader economic outlook being quite murky.
Haidi, let's bring in Mark Matthews, head of Asia Research at Julius Baer, for his insights. As we continue to watch, Mark, all of these tariff threats, what are you focusing on in the Asian market session today as you're just trying to gauge all of the noise and what is actually an investment theme?
Well, Asia seems to be doing quite well. The problem for us is the dollar, and of course the dollar has strengthened over the last 24 hours. So when it does strengthen, it's a headwind. But the big market, of course, in our region is China. And as you well know, things have changed. It is now a bull market, in fact, and I think it will continue to be so. I can find a whole bunch of reasons why Chinese stocks should continue to go up. And then the rest of the region, I don't see a lot of good stories, frankly. So China's the place to be right now, in our opinion.
Where in China exactly? Because we have seen a lot of optimism around DeepSeek and just cheaper AI models, technological advancements. But at the same time, the broader economy still seems to be pretty sluggish.
Well, that might be a good thing in the sense that we've got the National People's Congress coming up, and there could be some helpful signs coming out of that for the economy. But the way I'd position myself in China would be half in tech, and as you rightly say, DeepSeek puts that back on the map, but so does BYD, so does Huawei. There's a whole bunch of things that China's doing that prove it's at the forefront of technology and can be competitive globally. And the other half I just have in value, of which there is still a tremendous amount in China. And when I screen for stocks that we rate buy or hold, where the price-earnings ratio is numerically below the dividend yield, which is just a classic way of finding distressed prices, I still can find around 24 stocks. So that's the way I'd approach it.
Typically, we see, the exuberance or the downside in China being driven by sort of the whims of the government policy, right? Do you still think that's the case? And I guess, are you looking for any expectations when it comes to the MPC next week?
Yes, I mean, I think that there's a whole bunch of things that could come out of that. More on the trade-in policy for old consumer goods, more for helping low-income people, finishing unfinished property projects. There's a lot that could come out. But since I mentioned property, let me just say another thing which I foresee this year is a bottom in residential property prices, which have been falling for 3 years and really have been the biggest weight on consumer sentiment because 80% of household wealth is in property. But sales volumes have been flat for about a year now. In some of the big cities, they're actually starting to rise. And developers, many of them are now starting to pay a premium for raw land, which is a signal, I hope, that they think property prices are going to stabilize. So if that happened, it would be a major plus.
That would be the game changer, right, in terms of, as you say, how closely correlated property prices are to things like household sentiment and to a variety of other really important industries as well. Does that mean you expect the government to finally do something on the inventory side of the problem?
Not really. I think I think they're being parsimonious about that. That would be a surprise. I think they're doing it. They're trying to leave it up to municipalities to solve the overhead problem, and the central government so far hasn't made it a nationwide project. But even so, I do expect property prices to bottom.
Mark, is China your only preference in the region right now? Because others would argue perhaps we could see more opportunities even in Japan or even Southeast Asia or India, where we've seen a big sell-off recently.
Well, in Japan, the way we approach it is to do a bottom-up kind of selection, because overall the return on equity of Japan is low. It's dragged down by the keiretsus, the conglomerates, and the banks. So the TOPIX is return on equity is below 10%. But you can easily put together a basket of however many you want, a dozen, 2 dozen, high return on equity companies that make very complex products that are difficult for other people to compete against. And of course, with the yen being where it is, that's a plus for them too. So I would rather put together a basket of good quality global brand names with high returns on equity in Japan than just buy an index. And then India, yes, it's come down to 18 times forward price earnings, which is quite reasonable. I think the problem is that the government not spending much last year and the Reserve Bank telling commercial banks not to lend much to bring down their loan deposit ratios has had a impact on consumer sentiment and therefore spending. So I'm not looking for a quick turnaround there, but I would say it is our long-term buy and hold market in Asia. China I'm looking at as a kind of one-year investment, but India is the only emerging market, in fact, I think people need to own for the long term.
Mark Matthews, good to have your insights, head of Asia research at Julius Baer there. And here in Japan, we continue to watch 7 & I having its best day in about 7 weeks. It's seeking deals in Europe to expand its business. We are now hearing that they're aiming to add 10 more countries by fiscal 2030 and triple sales to 30 trillion yen. This, of course, as we're watching 7 & I facing increasing pressure to consider that proposed takeover by Canada's Couche-Tard. We have more ahead on the Asia trade. This is Bloomberg. President Trump threatening China with an additional 10% tax on its exports to the U.S. in a move that could worsen trade tensions. Let's bring in our China correspondent, Bingmin Lo in Hong Kong. Bingmin, so President Trump now saying this would be a 10 plus 10 in terms of tariffs against China. What do we know so far?
Yes, it's on top of the 10% tariffs that had kicked in on February 4th. So this additional 10% will kick in 1 month later on March 4th, which is actually March 5th Beijing time, the first day of that NPC meeting, the parliamentary session in China. So we're going to have a packed agenda next week because we're likely to see China retaliating next week as well. And this is, again, the pretext of this is the fentanyl issue. President Trump saying the levies on Mexico and Canada will come in on the same day on March 4th as well, after that 1 month grace period. And that is even despite Canada and Mexico taking these measures to strengthen border security. He says that drugs are still coming into China. And of course, the precursor ingredients for the fentanyl is coming from China. His administration officials had said that they are open to striking a trade deal before March 4th, but that is just less than a week from now. And we are seeing the immediate impact here is on the yuan, which slid about 0.5% yesterday. And you look at the Golden Dragon as well, down close to 1%. Investors clearly worried about what this would mean for China's export and its economy. And our Bloomberg economics team had put out a note saying that the original 10% tariff would have been manageable for China, but an additional 10% that would be equivalent to double the scale of the first trade war, and it could essentially cut China's exports to the US by about 50%.
Of course, all of this could depend on how well that bilateral relationship is forged, right? We do know that on a sort of senior military level, we are expecting these talks.
Yes, so the Chinese Defense Ministry had said that they are in the preliminary stages of facilitating these high-level military dialogue. And the last time we saw a publicly known military dialogue at a senior official level was in September under the Biden administration. And this is not new. It is essentially a continuation of China's policy to maintain open lines of dialogue when it comes to military. And this comes amid the ratcheting up of tensions, the Trump administration enacting a series of measures that are targeted at China, and also the geopolitical winds shifting because Trump has been trying to peel Russia off its dependence from China. It's been ambivalent about whether it would come to Taiwan's defense, for example. And meanwhile, China has been projecting power further afield, sending its navy closer to Australia, ratcheting up the rhetoric when it comes to Taiwan, saying it would take a more proactive stance. And this morning we had a few editorials on Chinese state media taking a very intimidating tone when it comes to threatening the Taiwanese ruling party, the DPP. So tensions dialing up on all fronts, but I guess this is the one good thing, that both sides are still committed to maintain that military dialogue.
Bloomberg's China correspondent Min Lo there. Well, UK Prime Minister Keir Starmer appears to have charmed President Trump with the help of a personal invitation from King Charles to attend a second state dinner. Starmer is visiting the White House, and while he was unable to obtain the security guarantees he was after, he did make progress when it comes to trade. Bloomberg's Michael Heath joins us now. So less progress on Ukraine, a little bit more when it comes to trade talks.
Yeah, I mean, I think this was a masterclass in Trump management by the British Prime Minister. There were a lot of doubts about him going into this. You had the UK populist leader Farage, who's been surging in polls, saying that that the Labor Prime Minister wouldn't be able to deal with Trump, couldn't get anything going, and it looks like he's done exceptionally well. As you mentioned, obviously Ukraine, he wanted a backstop, a US backstop for any European boots on the ground. He hasn't got that yet, but Trump he equivocated somewhat in saying that, look, until there's a deal, we won't, let's take things one step at a time. What the UK is actually after, though, is that if France, Britain, other countries put boots on the ground, they want sort of that overarching US support, US air power, US intelligence, all those fabulous things that the American military has there. So I don't know if you could say that that's out of the question at this stage, but Trump hasn't committed to anything. And it was interesting too. Trump was really quite diplomatic. He sort of cracked this joke about whether did he really say that, call Zelenskiy, Ukrainian President Zelenskiy, a dictator, and also alluded to the fact that that Zelenskiy is due in the US on Friday. But one thing he also said is he didn't believe Vladimir Putin would break his word on a deal, which I guess is politeness, but history would sort of suggest that there's a lot of wishful thinking there as well. I mean, any deal is going to require a lot of power, and the US is the most powerful country, so that's something that Europe is really going to have to work out.
So what are we expecting when President Zelenskiy finally meets President Trump?
Yeah, it's going to be very, very interesting. Obviously Zelenskiy's coming over to sign this resources deal. Basically, it's to set up a fund, a Ukraine and US managed fund to help develop natural resources in Ukraine and various areas. And President Trump says that this, in a way, is sort of like a security agreement for Ukraine because there's going to be American workers on the ground and investors in Ukraine, and so if somebody attacks Ukraine, the risk of an American citizen getting hurt is enough to dissuade them. Now, I don't think that Europe or Ukraine sort of buy that as such, because it's going to be quite difficult to get investment into Ukraine, to get things happening there if there isn't a proper security agreement or a sense of stability that Ukraine isn't going to fall under attack in a year or two when Russia has sort of got its forces going again. So it's going to be very interesting. But even more than that, it's sort of going to be the dynamic between Zelensky and Trump. I mean, obviously we had this extraordinary situation last week where Trump was calling Zelensky a dictator. Zelensky fairly accurately seemed to be saying that Trump was sort of repeating Russian disinformation on various things about the Ukraine. But as I said, Trump sort of seemed to walk that back, and obviously whatever Ukraine can get here in drawing the US into a sort of a long-term relationship with Kiev and the government there is going to be positive. But it's going to be the chemistry between the leaders that'll be very interesting. We know that Trump is a big fan of Putin. Obviously, Zelensky has said straight out that Putin is a murderer. He invaded his country, he's killed a lot of people, he's attacked civilian infrastructure, or he's ordered the attacks on that. So it'll be interesting to see how the two reconcile that.
Bloomberg's Michael Heath there. Well, EU leaders will call for increased flexibility in their funding rules to boost defence spending, responding to growing challenges posed by Russia and President Trump. Draft conclusions for the March 6th summit seen by Bloomberg show European Commission President Ursula von der Leyen is expected to present a letter with funding options. Earlier this week, she called the situation a once-in-a-generation moment. Let's take a look at how we're opening up when it comes to the European trading session going into Friday. Pretty muted here in Asia, of course, and not a great handover from Wall Street either. You're seeing some downside there when it comes to Euro Stoxx 50 futures. German DAX futures also off by about 0.5%, but still these are stocks that are coming off record highs there as we see President Trump ramping up that tariff threat. These worries about the trade spat, automakers in particular in the previous session sinking after the 25% tariff threat was spoken of by President Trump. Shery.
And Haidi, coming up, we'll dive deeper into Nissan's mounting challenges as the Japanese car maker looks for a new CEO and outside help. This is Bloomberg. Take a look at how Nissan is trading at the moment, down more than 2.5%. The company facing financial struggles, forecasting its third annual net loss in 6 years, and its CEO Makoto Uchida is under pressure to resign. Nissan's mounting challenges are the focus of today's Big Take, and Bloomberg senior editor Reed Stevenson joins us now with more. And Reed, you've been following this company for the longest time, and after that potential failure of the merger with Honda, what happens next?
Yeah, I mean, if you take everything that's happened from the announcement of the merger to the announcement that it's not happening, Nissan's financial situation, debt overhang. I mean, it really does feel like 1999 all over again. That's when Renault exchanged Nissan's debt for an equity stake in the company, sent in Carlos Ghosn, who did cost cuts, introduced a faster pace of products, and really turned the company around. And, the irony is that the company seems to be right back into that situation where we have the financial woes, we have a CEO who apparently the board is losing faith in, and so therefore really the big question is, what next? And it sounds like they're going to need a new CEO and or a new partner or rescue partner.
So what was Makoto Uchida like as a CEO, especially after Carlos Ghosn?
Well, if you go back a little bit to the arrest of Carlos Ghosn in 2018, Uchida was installed about a year later after there was an interim CEO. And I mean, maybe the right way to put it is he was a compromise candidate. He was somebody who was backed by Renault because, he was seen as somebody who could watch out for the interests of its biggest shareholder, the French car maker. But really, that may have backfired. Right, because what Nissan did need was, essentially somebody like Carlos Ghosn to take a strong hand, and so there was infighting, and there was, turnaround strategy didn't quite pay off, and so all of that has really come to fruition right now.
Reed, how narrow is the path now to, survival for Nissan now that Honda didn't pan out? What options remain?
Yeah, I mean, none of this is really going to happen overnight, right? This is going to take a while to play out. At least for this year, Nissan's debt situation appears to be manageable. It's really next year when they hit this sort of large wall of debt that really things are going to come to a head. But obviously, what we saw in December and until now with the talks with Honda, the essentially search for another partner, is that there is a sense of urgency. And so I think in the coming weeks and months, we're going to see all this play out, both in terms of new leadership at the company, as well as what sort of partnership they're going to be able to forge to really find a way forward. Hey, it could be Honda all over again. It's not like they decided to part ways completely. They're still going to collaborate on certain technologies, especially in the EV arena.
Yeah, tell us a little bit about their business in the EV space, because they were once supposed to be leaders there. What's happening now?
Yeah, I mean, essentially, they had the EV just way too early, and they made their mark there. In a sense, that early introduction of the EVs led them to not invest as much in, say, hybrid technology. And so, but that's where the demand is right now. That's why Toyota is doing so well and selling 11 million cars a year, because, the advent of EVs is not happening as fast as most people thought, especially in the biggest markets of the US and Japan and Europe. And so, therefore, they what they need to do is essentially come up with a hybrid answer, continue to invest on EVs, and just keep the underlying business going until they can get there. And that's monumentally hard. I mean, it's not easy for any legacy car maker to make that transition right now.
Bloomberg's senior editor Reed Stevenson with today's big take on Nissan. Thank you so much for that. Let's check on SoftBank, because it's now seeing its worst day in about a month. We're talking about declines at a 1 point top 5% in today's trading session. A lot to do with their investments around AI. Of course, we are seeing Nvidia sinking overnight, given their good earnings, but perhaps not great earnings. So there's been a lot of skepticism about the tech sector, about semiconductors, and just all AI investments. And SoftBank, of course, with the Stargate AI infrastructure build out, not to mention, of course, just their overall AI strategy, might be feeling the downside pressure with other tech names. We're also hearing that SoftBank is now in discussions with former Treasury Secretary Steven Mnuchin to salvage a deal for Cyber Reason that has lost most of its value given boardroom turmoil. Haidi.
Shery, let's take a look at some of the other corporate stories that we're following this hour. And Tencent has released its Turbo AI model that claims it's faster than DeepSeek's chatbot. The Huiyan Turbo S is designed to respond as fast as possible, and Tencent says the deployment cost of the model has also been reduced. The release comes a month after Alibaba benchmarked its latest Qwen AI model against DeepSeek. OpenAI is rolling out an early version of a long-awaited artificial intelligence model to select users. The company claims that GPT 4.5 is better at responding to subtle cues from written prompts, particularly good at chatting, writing and coding. OpenAI hit snags in developing the system last year. The rollout will be limited with a $200 a month subscription. We are just getting some breaking news crossing the Bloomberg now from the SEC, expressing concern about the liquidity, the valuation when it comes to private credit FDF. And we have seen that novel private credit ETF, I should say, from State Street and Apollo Global Management starting trading on Thursday. It was seen as really a watershed moment for this $1.6 trillion industry. They have really gained ground over rivals when it comes to offering that ETF with outsized exposure to the asset class. And we've seen Apollo pledging to originate a portion of those investments for the vehicle alongside providing intraday price data. We're now seeing the SEC expressing concerns about scenarios including liquidity and the valuation of such private credit ETFs. And we are now seeing that, the ETF will cap investments deemed liquid at 15% to conform to those SEC requirements. That private credit exposure is expected to sit around between 10 and 35% of the portfolio, according to that filing. This has really been seen as a seismic shift, but of course a lot of the concerns over this boom, Shery, in private credit is the illiquidity, the difficulty in trading and some of the opacity there as well. And it looks like the SEC is expressing some of those similar concerns.
Yeah, it's been such a hot part of the market, right? Apollo, in fact, trying to build with other peers that marketplace devoted to private credit. But we'll continue to watch the developments around that sector as we're seeing here across Asia. Broad downside pressure, the Nikkei falling more than 2%. And of course, a lot to do with just expectations of those trade tariffs to come into place next week on Canada and Mexico, potentially an additional 10% on China. The Kospi also losing more than 1.5%, affecting sectors like semiconductors, automakers as well. But take a look at those chip makers, of course, because as we talked about, we have seen those restrictions when it comes to Chinese tech as well. So here across Japan, we're seeing Tokyo Electron, for example, the equipment maker for semiconductors, losing more than 4%. There has been talk about whether Tokyo Electron can continue maintaining some of that equipment that it's already sold to China. And take a look at the Japanese yen, because we're seeing a little bit of upside against the U.S. dollar, still pretty steady, very close to that 150 level against the U.S. dollar, still at around that 4-month high versus the greenback. What's interesting is that the yen has become more vulnerable and sensitive to economic data. We have seen the dollar-yen exchange rate moving about 0.11% and 0.18% after wage and GDP data releases. So basically becoming very sensitive to economic numbers. In fact, today we got inflation in Tokyo slowing more than expected last month as government subsidies meant to offset energy costs distorted readings. It's a result that isn't likely to deter the Bank of Japan from considering more rate hikes. Bloomberg News senior editor Brian Fowler joins me now here in the Tokyo studio. And of course, we follow the Tokyo CPI because it gives us an indication of nationwide prices. Where are we at right now?
Yeah, so Shery, you mentioned the yen, and we actually saw the yen sell off a little bit after the data came out. And I think that reflects a view from the market that the Tokyo CPI looks a little bit weaker compared with the national trends. But there are some special factors there. There's education subsidies that are only in effect in the capital. So I think if we put that aside, the data today show that the underlying trend does remain strong. Inflation is still above the BOJ's target and will absolutely keep the central bank on the path to further rate hikes in the coming months.
What are some of the sort of global headwinds or uncertainties that could potentially jeopardize the path or kind of change the calculations that we're looking at here?
Yeah, Heidi, I mean, that's definitely something to be concerned about. Obviously, protectionist move policies from the U.S. could have a direct impact on Japan as well as an indirect impact as it affects Japan's trading partners. But I think another thing to look at is some positive news we've seen from the wage talks so far, just in the last week. Last week, we saw Teikoku Data Bank surveyed more than 11,000 companies and found that a record number of them plan to have wage hikes this year in the coming fiscal year. That doesn't talk about the actual scale, but it does show that the trend is broadening. And then just yesterday, we had news from Metal Manufacturer Union, and their requests going into the negotiations is a record high amount of increase, record high percentage. Of course, that doesn't guarantee they'll get that in the talks, but it shows a level of optimism, and that will probably affect expectations across the board in the labor market. And that is a really good sign for the BOJ, as it indicates that workers are confident and they may just achieve this virtuous cycle that the BOJ has been waiting to see.
And perhaps those expectations from workers is why they continue to spend. I mean, what I found really interesting in today's retail sales numbers and industrial production was that, okay, consumption seems to be solid, but perhaps external demand in terms of exports and industrial production weakening.
Yeah, exactly. So the industrial production data showed weakness. It fell. Part of that may be the Lunar New Year holiday effect because it occurred in January this year, and that may have damped some demand from China for Japanese goods. But as you say, the retail sales numbers look pretty good. And another thing to think about is, I mean, Japan's population continues to fall. If you think about retail sales and consumption on a per capita basis, I think it's holding pretty steadily. So that's definitely a positive factor for the Bank of Japan.
Bloomberg News senior editor Brian Fowler there. Well, China struggles with stagnant consumer spending, weak inflation and a debt-ridden property market are raising concerns that the economy is headed for a repeat of Japan's so-called lost decades. This is obviously the Japanification of the Chinese economy has been discussed at length, and Bloomberg Originals now takes a close look at how China might still be able to avoid that fate.
These days in China, people are looking for cheap eats. That's because a lot of people are feeling kinda broke. Discount delicacies like these have gone viral, especially at affordable spots like this Japanese restaurant, Caesarea. But meal deals aren't all China's picked up from Japan. The whole economy is looking disconcertingly similar. Stagnant growth, a burst real estate bubble, falling bond yields, a sluggish credit market, and an aging population. Not to mention price growth, close to zero. And it's pushing ordinary Chinese to be frugal at a moment when policymakers desperately need them to spend.
就现在看来，我觉得可能不会有前2年这么好的一个时期了，就是可能会越来越往下的去下滑。
While China's present economic malaise echoes Japan's at the turn of the millennium, some fundamental differences offer optimism that recovery is possible.
If you look at some of the things that have happened more recently, I think that suggests that there's a possibility that China could see the sort of innovative breakthrough, the technological advances that could really change the trajectory of the economy in the near future.
And subscribers can see that report in full on the terminal or on Bloomberg.com. More ahead, this is Bloomberg. President Trump's weekend support for Ukraine is casting doubt on the long-held policy of strategic ambiguity toward Taiwan. Bloomberg spoke exclusively to Taiwan's vice premier about how the island is viewing the changes in U.S. foreign policy.
安全或经贸合作上那所以我们也
The US has always been Taiwan's most important partner in terms of regional security and in trade. We are attentive to the policies of the new US administration, and different local agencies have been studying new areas for cooperation between us. The more important thing is identifying a strategic direction for the US and Taiwan and maintaining a mutually beneficial working relationship so we can build a democratic supply chain that strengthens the US's leadership in the global high-tech industry, while also helping Taiwan maintain its competitiveness in making contributions to high-tech development.
And what is your assessment of the way that President Trump has changed his position very radically from the Biden administration on Ukraine?
我想我国一直都持续的在关注
Taiwan has been monitoring the development of the war in Ukraine and related updates from Europe. We want to do our part for the Indo-Pacific region. Enhancing military capabilities is the basis for peace. We want the Taiwanese people to recognize this. Therefore, we are not only committed to building up our defense capabilities, we are also strengthening our economic resilience. This way, we can continue to take on important roles and increase our contributions to the world. President Lei had set the 4 pillars for peace. They represent objectives like enhancing Taiwan's defense capability, enhancing economic safety and resilience, continuing cooperation with like-minded countries, and lastly, supporting orderly exchanges between Taiwan and China.
How does Taiwan prepare, though, for other eventualities? Because there's the tariff risk that is still very present, not yet fully clarified, but there's the chance that we see 25% tariffs on Taiwan semiconductors. How is the island preparing for that?
我们都密切的在关注美国新政府相关的
We are tracking new policies from the Trump administration closely. We want to show that the future of the Taiwan-US cooperation is focused on cutting-edge technology. This is mutually beneficial and it should be a shared goal. And we're willing to expand our investments in the US with the aim to amplify our innovations in technology, including AI, chips and drones, and even R&D in future technologies. We want to stay leaders in the high-tech industry amongst democratic countries. This strategy is critical for both of us. We will also make efforts to balance trade and our increased investments in the US.
Do you think that the US is still a reliable security partner to Taiwan?
我们认为台美是 区域安全跟经贸合。
We are important partners on regional security, trade and economic collaboration. We hope to deepen ties with the US, and we believe it will be done on the basis of the Taiwan Relations Act and 6 assurances. Since Trump became president, he's emphasized the importance of keeping the cross-strait peaceful and doesn't want to see a unilateral change of status quo by force, and most democratic countries share this same view.
Taiwan's Vice Premier there speaking exclusively with Annabelle Julius. Well, President Trump says he'll sign a minerals deal on Friday with Ukraine's leader Vladimir Zelenskiy. Trump has called Ukraine a huge economic development project, signalling that the deal will make the US a partner in developing Ukrainian oil and gas. The White House says the deal is the first step in their plan to broker an end to Russia's war. Let's bring in Sara Meger, who's a senior lecturer in international relations at the University of Melbourne. Really great to have you with us. And of course, this is we're gearing up for the meeting between Zelenskiy and Trump. I guess, first off, how do you expect that dynamic to go?
It's going to be an interesting one after Trump's social media comments towards Zelenskiy following his meeting with Putin in Istanbul last week. I think it's really forced Zelenskiy's hand, and I think Zelenskiy's interests are going to be trying to make sure that any push for peace negotiations that Trump appends to this minerals deal that they'll be talking about on Friday doesn't see too much giving away of Ukraine interests in favor of just ending the conflict.
It's a difficult position that Zelenskiy finds himself in at this point, right? Do you think any of the sort of international pressure that the Trump administration has found itself under, given its aligning of policy with Russia, is going to make any impact in terms of how these final steps of, the contours of the peace deal are going to play out?
Absolutely. For the last 3 years, Ukraine's position has been quite definitive, right? No negotiation, because this was a war of aggression, that they want their territorial integrity maintained, they want their sovereignty reinstated. And Trump has been, a very different type of foreign policy maker on the international scene. And his position on Ukraine has shifted between terms, right, from his first term to this one. His interests are much less aligned with European allies in terms of seeing the war on Ukraine as instability for the whole European region. For Trump, he sees it much more through the lens of an investor, and that the US hasn't been seeing a return on their investment in the Ukraine conflict. So I believe what we're going to be seeing is a lot of pressure from Trump to find an end to this conflict in a way that's going to open up opportunities for return on that investment. And that's why this critical minerals deal is so central to Trump's foreign policy agenda towards Ukraine.
What are the long-term implications of such a policy change coming from the United States? This sort of transactional foreign policy where we're talking about investments and the U.S. as an investor rather than a leader and defender of global democracy.
Yeah, so this does represent quite a significant shift in U.S. foreign policy compared to Trump's predecessors, where, a large part of U.S. national interest was understood in maintaining this global, liberal international order, or the rules-based order, as it's often been referred to. And Trump himself is far less concerned with the sort of makeup of governments that he negotiates with or makes deals with, and more so aligns himself with personalities or people he thinks he can do deals with. And this means that we might see a growing divide or rift between how Europe's still very much focused on maintaining this liberal international order and the U.S., pursuing U.S. interests, whether it aligns with the institutions of this order or defies them. But I think what it also signals is some chance for no longer having this new Cold War emerge between what we've seen as rogue states in the international system and the West. Trump's mercurial and unconventional foreign policy style may actually offer more opportunities for negotiations and deals where prior administrations had taken very hard line, you're either with us or against us kind of approaches.
And yet, could the opportunities fall for the United States itself if we have an opening for other powers to emerge even stronger, like Beijing, when they've already made inroads in the likes of Africa, Latin America as well? The U.S. now starting to cut off international aid, which was at one point also supposed to help America's soft power around the world.
Yes, of course. I think Trump doesn't really understand what that long-term national interest of U.S. foreign aid has been under this liberal international order, and the way predecessors might have seen it as an investment in fomenting democracy and economic liberalism, and therefore how U.S. interests are maintained in sustaining those sorts of liberal orders outside of, North America. But for Trump, I think it could offer an opportunity where instead of seeing China as an adversary, particularly an economic adversary, maybe more so opportunities for co-investment or mutual investments in these economic developments. But I think given he is such an unpredictable foreign policy character, it's really hard for us as international relations scholars to anticipate what future negotiations might look like or how his position with China might shift. He has this tendency to sort of change his position in terms of whoever was the last advisor he's spoken with. So we've seen he's made a slight shift in these talks with Keir Starmer today in terms of his position on, security guarantees to Europe, but it's still not a wholesale shift. So what I'm saying, I guess, is we can't really fully anticipate what the future of that bilateral or economic competition with China might look like.
Sara Meger, good to have you with us, senior lecturer in international relations at the University of Melbourne. Coming up next, we hear from one of Taiwan's leading drone producers about where it's seeing demand and its growth outlook amid geopolitical tensions and looming tariffs. This is Bloomberg.
Well, Quadtronic Intelligent Robotics is one of the leading drone producers in Taiwan. Its technology and manufacturing capabilities are now attracting international interest. Julius spoke with the company about their outlook when it comes to demand and growth.
We hope that we can provide ODM service for the worldwide. That is our mission. And we don't plan to have overseas to set up our brand names, self-sales, networking, because this is what we really good at, manufacturing, quality control, and the new technology to introduce.
So you see more US companies looking to Taiwan to manufacture drones?
Yeah, I think this is a way because Taiwan still got a very good background, and we got all necessary fundamental technology and skill, no matter it's a manufacturing or supply chain, and also, of course, the technology. So I think China maybe not right now for the government use is maybe not in their list. So I think Taiwan should be the best choice for them at this moment.
How concerned are you about tariffs, though, and the risks that those are put on to products that are made here?
I foresee that probably this will be the topic, but so far, because we still got a price benefit for the drone in the market, so I think we will, if the range is not so significant, I think we still can live for it. Yeah.
What level of tariff, then, could you withstand?
I would assume like a 10% around, but it's not easy to guess what the U.S. government right now, what is our target for it.
So after 10%, though, if that's applied, do you still think that Taiwanese drones are competitive?
That would be a kind of challenge, I may say. Yeah, more than 10%, that would be a challenge. But I think right now we will have a different, we will not only use the price to get the customers, I think we also using the new technology. So I think that both ways that we can make sure, not because the customer buy our drone, not because only it is cheaper, but also it is as good as a U.S. the drone.
So we know the Trump administration has a big effort to onshore or reshore certain critical industries. Do you have any plans to establish a presence there, whether that's through your own new site or by forming some sort of joint venture?
Because right now the quantity demand from U.S. Is good, but still not to support for the factory in U.S. So we will see if timing is right. We also will consider this option.
So what's the quantity? How much demand do you need to be able to justify?
It's going to based on the profit we have. So I think maybe some kind of a veto or something. Some others high value product come out, it's more possible make this happen.
If you got orders for a VTOL product, so vertical takeoff and landing type product, that would be something that would make you move?
That could be the one of reason, yeah. So again, we'll see that what is the revenue we can get if we move to the US. I think this is something that we will think about.
Cortronic Intelligent Robotics Corporation's Andy Jassy speaking with Annabelle in Taiwan. We have seen geopolitical risks, tariff threats, really leading gold to emerge higher. We saw so many record highs this year already, although now we're headed for the first weekly loss when it comes to the price of gold. This coming at a time when we're seeing a resurgent dollar, of course, the best day in about 3 weeks. That's weighing on the currency, Haidi.
Take a look at how we're setting up when it comes to the Friday session here in Greater China as we head into that open. A50 China futures up by about 0.3%. Of course, we've really seen further upside when it comes to this part of global markets compared to, of course, the sell-off that continues to plague the US stocks. But we'll have to see how the additional 10% on tariffs on Chinese goods plays out.